Even with the price of crude pulling back to the mid-40s, you have to recognize that not all producers are challenged companies with overstretched balance sheets, potentially dangerous stocks. There's still a number of high-quality independent oil producers that are doing everything they can to take control of their own destiny, despite persistently low oil prices. Consider Carrizo Oil and Gas. That's CRZO. It's a $2 billion independent exploration production company with lots of low-cost assets in the Eagle Ford Shale and Permian Basin in Texas, as well as in the Niobrara in Colorado and the Utica and Marcellus shales in Ohio and Pennsylvania. Carrizo has been aggressively cutting costs while doubling down on its most productive and cost-effective wells, particularly in the Eagle Ford. They've added a bunch of hedges. Plus, just last week, Carrizo did a big secondary offering in order to shore up its balance sheet, selling over 6.3 million shares at $38.50, a 6% discount to where the stock closed the day before. And you know what? The stock has held that level, and more so, meaning everybody got in on that offering has made money, albeit not much. I mean, the stock's currently trading around 39. That said, Carrizo did another 5.175 million share offering back in March, which rate was priced at $45.50. And while it looked like a good deal at the time, you're now underwater if you didn't ring the register. Still, at these levels, Carrizo's already rebounded roughly $10 from its late September lows when the whole oil complex was being crushed by forced selling from troubled hedge funds. Once the third quarter ended, though, the stock took off, and I wouldn't be surprised there was more room to run if oil has a little bit of upside here. Oh, and let's not forget, Carrizo's rallied more than 20% since we last spoke to the CEO in December of 2014. So let's check back in with Chip Johnson, the president and CEO of Carrizo Oil and Gas, hear more about his company, where it's headed, what it's doing. Mr. Johnson, welcome back to Mad Money.
Thank you, Jim. Glad to be here.
Chip, I've got to tell you, you raised the money because you're a prudent man, but you also talked about in September 28th conference call that although you have a pretty strong balance sheet, this quoting you, we are trying to take advantage of opportunities to expand, primarily in the Eagle Ford and Delaware. It hasn't worked out as well as we've hoped. The bid ask on these deals hasn't come down as much as we thought. Is that still the case during this most recent plunge?
No, the bid ask has come in, and we're trying to take advantage of that. So really the main reason we did the equity offering is we have some deals in the works that we're trying to close. None are guaranteed, but we think we're going to get some of those closed, and maybe about half the proceeds would go to closing those deals, some that have production with them, and then the rest of the capital could go to drilling on those deals next year, depending on what oil prices do.
And what's a typical break even on some of these, Chip? What would the wells cost? Because there's a lot of wells that at this 45, 46 don't make money.
That in the Eagle Ford, for instance, we could drill wells for $4.8 million that'll break even at $40 to $41. I think 80% of our inventory breaks even at $41 or less. In the Permian, the wells are more expensive, but some of the ultimate recoveries of these wells are higher than the Eagle Ford. So we think that the break-even prices are probably going to be in about that same area. And that's why we're focused on that region.
Now, are you able to lay off some risk or to bring in even more income by doing some hedging or selling calls to be able to make it so you augment how much you get in?
We have done that recently. We decided that with this rally in oil prices up to about 50, that brought the 12-month strip into the low 50s, and we were able to hedge some oil in 2016 for $60 a barrel, which is well above the numbers we've run in our models. To do that, though, obviously we had to give up something. So we gave up, we wrote some calls for 2017, 18, 19, and 20. And we don't like giving up upside because we think prices are going to come back someday. But we felt that was prudent to give up some upside in the future, maybe on 10% of our production in order to lock in 2016 and be comfortable.
All right, Chip, what does it look like out there? I know that when oil went back to 60 in the spring, a lot of guys got real bullish. A lot of guys have really kind of not cut back the way you expected. Are you looking at a universe where a lot of the publicly traded companies could end up being hurt, or is it really just smaller operators we don't know?
No, I think there's some big companies that might have stretched too far. You're right, in May, we were under a lot of pressure to add rigs because oil was starting to peak above $60 a barrel. And fortunately, we didn't fall for that. We said we needed to see $65 per barrel for a long time and understand the fundamentals for it. So we didn't do that. But there are some big companies that are starting to get in trouble. Fortunately, the market seemed to be finding ways to give them other sources of debt or some sort of mezzanine debt that can bail them out.
What is the fair price for oil, do you think?
It's probably a fair price now. I think one thing that's happened is the risk premium we saw for so long is gone. And that's a little troubling because there are not a lot of barrels left in the world that can come on. We know how many there are in Iran, and some of that could come on by year end. But beyond that, OPEC doesn't have that many barrels left to add, and with the world running at almost 97 million barrels a day right now, it wouldn't take much in an international incident that we could have a problem. So I think that the risk is to the upside. I don't think there's that much downside risk from supply and demand. Goldman might be right that we could dip into the 30s if we have the Chinese get the flu and all the refiners have maintenance. Maybe that could happen, but it seems to us like we're still in a trough. There's going to be a big upside down the road, and we're trying to become a big call option to take advantage of that.
Chip, is there something going on that we're not thinking about? For instance, I'm hearing that the Saudis have been working on some new fracking technology that would make it so that they could dramatically lower the cost of oil and how much they can take out of the ground, and that maybe what we're looking at is that we're not near as peak oil as much as we thought, and the Saudis have a lot more that they could pump.
I haven't heard that. I would be surprised if Aramco hasn't been looking into those kind of techniques for some time. I mean, horizontal drilling and fracking's been around now since about 2005, but most of their reservoirs tend to not be shales, so it's not as necessary to do that to get the oil out. It'll come out without spending that kind of capital.
Well, I've got to tell you, you're one of the conservative guys, which is the ones we've been sticking by when we do our analysis. I want to thank you so much, Chip Johnson, President and CEO of Carrizo Oil and Gas, CRCO. Good to see you, sir.
Thank you, Jim.
These are guys who are not only going to survive, they are thriving. Why? Because they're prudent and conservative. That's Carrizo. May have Money's back after the break.